Hey there, Jeff Lewis from Epic Trust Investment Advisors coming to you this week with our monthly Economic Breaker Panel update. So this is the update that we give on a monthly basis that we've started to do on a monthly basis with our Economic Breaker Panel. So think of this like your breaker panel in your house where you've got switches that you turn on or off. They used to be really big, right, where you'd have big levers. Now they're just little switches with your fingers. But just think of this as switches that we turn on and off, and we're just looking for how healthy the market is on a monthly basis from lots of different points of contact, and we're trying to get a good feel for where we are in the market. So with that, I'm going to dive right in. What have we got going on this month? This month we've got one indicator from last month that actually improved. Last month we had light truck sales was down last month, and we actually had a decline far enough to trigger a breaker panel switch on that. This month that's improved, and we've seen a pickup back in auto purchases for this last month. So that's great news. I really am glad to see that, and that's what we kind of expected to see. But for now, here forward, we should probably expect to see that number go up and down a little bit unless we can get some massively high demand out of our economy and businesses to purchase more trucks. I don't think we're going to see a whole lot more volume out of that indicator for a little while. So we probably will see that technical indicator here with light truck sales move up and down and probably in and out of positive or negative for the next several months until we either see a recession or we see a major economic boom. So anyway, for now, good news is that our light truck sales are in good shape. So with that, let's move to the negatives. We've got the technical indicator. The first technical indicator I want to talk about is this second one that says yes in yellow. It's the MACD on the S&P 500. This is one of our traffic light signals. This is an indicator that we look at internally as we're judging different investments from a technical aspect, not necessarily from a fundamental aspect. So let me explain the difference there. So a technical indicator is one that we would use math to make a judgment on. So 2 + 2 is 4. That's technical. That's something that is non-emotional. It's non-biased. It has no opinion. It's kind of the facts are the facts. So those are technical indicators, and we put those in a box, and they have their value, but they don't always call it right. So they work most of the time, and some of the time they don't. So then on the other side of the equation, we have fundamental indicators. So those are things like, how long has management been in place? What do we think about the economy moving forward, and what kind of demand do we see? What is the gross domestic product of our country doing right now, or our GDP? Is it growing? Is it declining? Some of those things are more fundamental in nature, and so those get judged differently. So both types of indicators, whether it's technical or fundamental, they have their good and their bad traits to them. Nothing ever works all the time, and every indicator works some of the time. Just like a broken clock, it's right twice a day, right? So same with technical and fundamental indicators, and that's why we try and boil things down into both of those indicators and really just kind of filter out what we can from the economy. And that's why we're looking at all of these indicators on this breaker panel, is so that we can begin to see from a holistic view, a more holistic view, how the economy is really doing. So with that, let's jump back to the technical indicator that we talked about, which is the MACD. The MACD right now on the S&P 500 is still showing just slightly negative. It's not too crazy. We're just about to break the lid on this. So I'm really happy to see that. That's what we expect to see out of the market as it's recovering. So we're seeing positive movement there, but it's not enough yet. We haven't seen enough positive growth yet to get over that hump. All right, so next up, we've got real interest rates. And based on the readings from last month to this month, we're actually in better shape than we were before, but we're still not in a place where real interest rates are negative. And this is kind of an interesting indicator, because a negative reading on this is actually good for the economy rather than a positive reading on this. So you can see that here. It's the fourth line item on our breaker panel, and it is improving. So it is indicating a slowdown right now, but this indicator is on an upward trajectory, just like the MACD was that we just talked about. So there's not really a whole lot more to say about that, other than since the Federal Reserve has leveled off and decided they're not going to be raising rates for the rest of this year, at least they've said that's what they're planning to do. We don't expect to see a whole lot of change here unless something else happens in the interest rate environment. So I'm pretty confident this one's probably going to stay just slightly positive, which means that it'll most likely continue to trigger this next month and probably for the next several months unless we have a major change in interest rates. And that could be affected by global interest rates as well from other countries and other banking systems. So we'll just kind of see how this goes. It is improving, or it has improved over the last month, but I don't expect for it to fully get to a negative reading, which would be positive for the economy. I know that's a little crazy, but we'll keep at it. The last thing we've got is durable goods without aircraft or defense. So this is showing a negative now for the second month in a row. In my opinion, we've got one of these factors is the government shutdown. Obviously, if they're not buying equipment and building roads and doing the stuff that they need to be doing or whatever it is they needed to be doing during the shutdown timeframe, that was a pretty long shutdown, that definitely had an impact on the amount of goods that were purchased by the government alone, let alone other companies around the U.S. that didn't purchase goods as well because of the uncertainty in our political environment at the time. So for those of you who've known me for a while or have been following some of my economic advice for a little while, or you've been a personal client, you know I'm not super huge on the effect of politics and how that affects the financial markets. Statistically speaking, and from a long-term perspective, most political moves don't affect the market for long periods of time. At least short political moves. So when things happen in the news or whatnot like that, little shakeups, they will affect the market, but it's typically very short-lived and they don't have long-term effects on the market, with the exception of financial moves that the government makes. So changes in the tax code, that's a big thing, and it takes a long time for that to work its way through the system. Changes in interest rates, that's not really a government move, it's a government entity move. The Federal Reserve has to change interest rates, but even that doesn't have an immediate impact on the market most of the time, even though we'll see some fluctuations based on what they're doing on a daily basis. For that really to affect the market positive or negative, or interest rate changes to affect the market positive or negative, it just takes time to work through the system, sometimes years. In fact, Federal Reserve Chairman Powell said in one of his last conferences, I believe it was in December that I was watching, where he said it could take up to 2 years for some of the decisions they're making today to be realized in the market, for them to be able to get a read back on the economy so they can make future decisions. Well, if they've got to wait 2 years, then we surely can't rely 100% on the news that's happening on a daily basis and 24 hours a day to be able to make long-term investment decisions. So with that, durable goods is an important one for our economy. I'm not going to make light of this at all. This is a little bit alarming. And it is negative for the second month in a row. Next month will be an interesting month because this indicator actually does have long-term effects on the market. So decisions that are made today on goods for purchase or equipment that gets purchased, it typically takes several months for those goods to be fulfilled or for those orders to be fulfilled. And that means revenue for companies for several months. And then from there, it means revenues for companies from installment payments for several months. And so this then filters down to payrolls and things like that. And so this one indicator, the durable goods indicator, is a pretty important one from a long-term trajectory of our country. And if this doesn't pick up in the next couple of months, that will be a little bit bigger warning sign, in my opinion, of the health of our economy. And we may start to see some of these other indicators begin to trigger negatively. So for now, though, let me bring it back to the present day. For now, we're in way better shape than we were in November and December from an economic standpoint. And even in November and December, if you watch my videos, and I did do one of these economic breaker panels in December, and things were a lot more gloomy then, but they were still a positive move on the market. Today, they're looking really good. We've got a lot of green on this chart, a couple of yellows, and just one red. Those are super positive movements, and I know you're probably feeling pretty good about where the market is. And if you're not, I encourage you to take a walk, get some exercise, stop worrying about the market for today, and we'll check back in next month, and I will let you know how these things look for this next month. I'll just do the quick takeaways. We've got one technical market indicator that's slightly negative for the S&P 500, but it is still improving, and we'll probably see that improve over the next couple of months to be a positive. So that's good news. Next good news, real interest rates is improving since March, still showing a negative indicator on the market, but it is improving, and it's only slightly negative. So I'm giving this, as well as the last bullet point, 2 yellows rather than full-on red indicators. Last one, durable goods. We are in tough shape on durable goods. We'll see how things improve. I really hope companies will continue to invest in buying equipment and their infrastructure for their businesses, because that means long-term growth for our country. So with that, we will call it a day, and we'll see you here in a week or so. Thanks a lot. We'll talk to you later.